This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
You've got deals that aren't working as well. Talk to your lenders, talk to your investors. You need to let them know, hey, here's the situation. Here's what we're doing. Maybe someone has an idea you haven't thought of that can salvage the deal, or at a minimum, at least they know that you care enough. You're being transparent. You're sharing things with them, and you're getting in front of it, and you're recognizing what your options are. And you're trying to make the best of maybe a situation that isn't ideal. So I think that communication is absolutely key, especially with your lender. And the other thing too is like your lender is your biggest investor.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey, awesome people. Ever wondered how you discovered this show? Was it a tweet? Was it LinkedIn? There's no ads or sponsorships here, just pure passion. So if someone guided you here, do me a favor, pay it forward, share it, review it, spread the word. You rock, and your support is everything. Thanks so much. Hey everyone, it's Augustino. The recent foreclosures on 3,200 Houston units has investors nervous everywhere about putting their money into multifamily. But here's the thing, all this bad news shouldn't have you sitting by the sidelines. Instead, what you really should be doing is still analyzing deals, looking for opportunities because they're out there. They're out there, okay? Our next guest knows all about this. Now, he got started doing 2 and 4 unit deals a long time ago, but he has now since invested in over $100 million worth of apartments. Now, he is totally passionate about consulting with active apartment investors to help them start or even grow their business. He is head of acquisitions and investor relations at Casmon Capital and a multifamily group that has invested in numerous deals that helps busy professionals achieve financial freedom. Now, with all that, I'd like to welcome John Casmon to the show. John, buddy, thanks for coming on, man.
Agostino, thank you for having me, man. I'm excited to be here today, and always great to talk to you.
Yeah, it's been been a couple of years, so it's good to talk to you too. Now, guys, I like what John has to say. You can reach him via his contact page at casmoncapital.com. Okay, John, go ahead and tell listeners about your journey.
Yeah, I mean, in a nutshell, as you kind of alluded to, I started off investing in smaller multifamily properties, but really even before that, I was in corporate America. So I worked in marketing. I was a marketing executive for 15 years, working on a lot of big brands like Nike, Coors Light, Mountain Dew. And while I was in marketing, I worked, unfortunately, for some companies that went through bankruptcy. So I saw how unstable or instable, a lot of these companies were. And for me, what really clicked was my time at General Motors when we went through bankruptcy on a really public stage. And I would watch my boss's boss on TV and talk about the state of the business and whether or not, we were going to be alive and have, a company. And it just made me realize that I needed something else. I needed to take more control over my financial future. And real estate was the one thing that felt accessible enough for me and for most people, but also simple enough. And I don't mean easy, but I mean simple enough to figure out. I wasn't going to be the next stock wizard and pick, the apples and whatnot out of the world, or I wasn't necessarily technically savvy to create the next app or anything like that. But real estate's a pretty good equalizer. It doesn't matter your background, doesn't matter your education, doesn't matter your history or, where you started. You can create something in real estate for the average person. And that was something that I always thought about with the information I did have and continue to educate myself. And as you mentioned, started investing in smaller properties, 2 to 4 units, eventually scaled into smaller commercial real estate, and then ultimately found apartment syndications or work with other investors to scale a portfolio that was once valued at over $100 million. Now, we've since sold some of those properties, but we have worked with investors to invest in these larger apartment buildings. And that is the crux of what we do today.
Yeah. It's your story is very similar to mine, right? In that you worked in corporate. There's all these things that happen. You have no control over your life and the money that's coming in. It's dangerous. I mean, I know that most people think that corporate America is a great place to be and, you get the steady income and all that fun stuff. But in actuality, I say it's riskier to be in corporate than it is not to be in corporate because you never know when your next kill is coming. That might be true, depending on how big your business is, of course. But at the same time, too, it's in your case, you're looking around. It's like all these bad things are happening. You have no control over it, but it's going to impact you directly. And who wants that? Who wants that? But even real estate, even as a plan B, is still acceptable to start off, right?
Well, and I think the biggest thing, and I'm not an advocate to say, everybody should quit their job, be an entrepreneur, right? That's not what I mean. And however, I do think it's really important for people to step back and to really evaluate their situation and to recognize that just because you've been doing something and it feels familiar doesn't mean that it's safer, right? And it's almost like, and I'm about to go kind of wild and off on a slight tangent, right? But it's almost like being in an abusive relationship. Just because it's familiar and you kind of are comfortable with this person doesn't mean it's the right thing to do or the right relationship to be in. And I'm certainly not going over the top, but I'm saying that, for me, what happened was, and I was fairly early in my career, which was a blessing because I had the audacity to think that I could do something else and to map out that plan. And the great thing about being at GM and going through bankruptcy was we did have a long roadway, right? That took almost a year before we actually went through that process. So I had a lot of time to think. And I was like most people, right? If you hear your company's about to fold, I updated my resume. I started making phone calls. I started applying for jobs. I went on interviews. But through that process, I kept saying, okay, but then what? Like, what if this company folds? Just going to keep doing this over and over and over. And what really, kind of helped me crystallize the plan was a senior executive. As a matter of fact, the person I was referencing, she was brought in from California to Detroit. She was like the Western region general manager. They brought her into Detroit to head up kind of our division. She became the face of the company. They stopped letting the CEO go on TV. If you recall, that's when all the three CEOs flew on their private jets down there. And they were like, wait a minute, you want the government to help you and you're flying on private jets? So they were like, yep, that's a bad look. Can't put him on TV no more. So she became the de facto spokesperson. Well, about a year after that, she kind of fell out of favor for whatever reason. And she was forced, however you want to look at it, she had to move to Shanghai. So picture going from California to Detroit to Shanghai in a matter of about 2.5 years, having a family with a son who was in high school. And that's the lifestyle change. So I had a seat to look at this and say, well, what am I aspiring to that? Is that what my future looks like? If I crush it, right? My goal, my success is some dude just not liking me, deciding, hey man, I don't like Cass. Why don't we move him to Shanghai? Why don't we move him to Istanbul or whatever the case may be? And I was like, you know what? Whatever, man. Let's take control of my future. And I think that's the thing that a lot of people don't realize in corporate America is that it's a game. It's politics. The money gets involved. And then you've got kind of the golden handcuffs where you make too much money to just go out and do something else. And quite frankly, your own self-doubt kicks in, right? You're making good six figures and you're doing well and you got the big house and the nice car. Man, it's real hard just to quit and be an entrepreneur at that point, right? Like we've put so much of who we are into that job that we kind of lose who we are outside of that job. And you see that with people all the time where they lose a job, they get let go, company folds, they retire, and now they have no idea who they actually are, right? Because they put so much of their identity into a title. So I think it's important to at least step back and either create passive income or create something else where you can stay true to yourself holistically and not tie everything you have to a job or a company or a title.
Yeah, love it. And you did that. You started with your smaller deals, and like you said earlier, you grew this thing up. You sold off some assets. You're still sitting on a bunch of them. We're in the green, we're talking about another deal you're working on right now. So you're still looking at deals. You're still doing deals, right? But I think the key here is that even in today's economy, when everybody's scared and hiding underneath their desks, you're still looking at deals. You're still looking for the opportunities, right? So tell us about how that looks. And obviously we're talking in the green room, like I said a second ago here, and finding debt is extremely difficult. Finding equity could be tough as well. How you guys put these deals together? What sort of underwriting criteria are you applying to try to find these types of deals?
Well, I think the first thing is talking to these, these debt and these equity players so you understand what they're looking for. The financing these deals is certainly difficult, but it's not impossible. So typically what we're looking at are value add apartment deals. And what I mean by that is we're buying a property that is already cash flowing. It exists. It's making money. It's 95% occupied. And what we're doing is we want to come in, we want to buy it at a fair value, but we also want to have a business plan to increase the value of that property. So what's going to happen for us is we're going to lenders and we're saying, hey, here's this property. Here's what it's doing today. Here's what we think it can do. And they're going to come back and tell us what they're willing to finance it for. Now, the banks, regional banks, the, short-term debt, those kind of loans are certainly not advantageous in this market. It's just the financing terms are not good, period. Ironically, agency debt is very favorable still. So if you can find a property that qualifies for agency debt, there is still an opportunity to make something happen there. So on the deals that we're looking at, agency terms interest rates are higher. They're higher everywhere. But the rest of the terms are fairly favorable. So those are things we're looking at. I think those deals can still work in this environment. You can certainly do bridge or short-term debt. I think there's more. I don't even want to call it risk. I'll just say there's more. There's certainly more uncertainty in a loan like that without knowing what the market's going to look like. 6 months from now, 12 months from now, 24 months from now, and we were talking about hey, interest rates are probably going to go up again. I feel like literally every week or every other week, the crystal ball changes, right? It's like, oh, this should be the last rate hike. It should come down after this, or hey, rates tend to come down 6 to 18 months after a big rate jump. Who knows, right? Who knows? So I think the big thing for us is as we're looking at deals in this market, and I am a firm believer that you should always be looking at deals. For us, it's looking at it from a long-term view. We don't want to try to time the market. I'm not trying to buy something today and be out of the market in 18 to 24 months and try to sell that asset in that time frame, right? So for us, it's got to work today, but it also has to work in the next 5 years, 7 years. And if I need it to hold it 10 years, I want it to still work in 10 years. So what does that mean for us? One, it means buying in quality locations. It means buying quality assets, or at least having a business plan to turn it into a quality asset, and making sure that our stabilized cash flow is strong enough to hold on to the property as long as we see it. I think the challenge that investors have is, again, if you're going in and you're trying to time the market, well, now you're hoping that the market is strong when you're ready to sell. And you and I know that we can't control that. So what we can control is the price we pay today, and then the business plan to drive cash flow. And even that has some challenges and some risk associated with it, but it's a little bit easier to project out what we can do from a cash flow standpoint than what we can predict from future cap rates or the exit or anything like that. So we're just trying to focus on buying quality assets that can deliver some good cash flow where we have flexibility on our exit.
Yeah, I think that if you're going to get some sort of non-Freddie or non-agency type of loan, for sure get a rate cap if anybody out there is listening. But even rate caps are tremendously expensive right now, especially on some of these deals that, if you're a 100+ unit deal, tremendously expensive. It's it's a whole different animal when you're trying to get rate cap and you're trying to get that type of expensive debt on it. The only way it works right now is agency. And I think the biggest problem right now for many sellers anyway is the length of time. Right? Because remember the days when it was 30-day look, 30-day close, easy peasy, no problem. Now it's like whenever if there's any new multifamily deals I would bid on, it would probably be like 45-day due diligence, 45-day close, with maybe a couple of extensions in there, not because I want them, but because, that's just how it is now. Right. Are you finding the same sort of thing then? Like just because of the slowdown ever since all the COVID stuff, getting people to show up and actually do all the third parties and the lenders, the lender third parties, all that has been tough. Like, have you seen the same sort of thing even today? Hey, my amazing Bulletproof Cash Flow tribe. Before we dive back in, I want to express my sincerest gratitude for being a part of this community. Your support is what keeps us going strong. If you've been enjoying the information that we've been sharing here, I have a quick favor to ask. Would you mind subscribing to the show and leaving a review on Apple Music? By taking these small steps, you'll help us continue to deliver exceptional content while expanding our reach to fellow investors just like you. Thanks so much for your unwavering support. And now let's dive back in.
Yeah, it's tough. And, if you think about it at a high level, everyone's nervous. So there's going to be more, I don't want to say more due diligence, but I think there's more criticism, or people are really paying attention to every single step, right? They're looking at all the documents. They're looking at all the reports. If there's a question, they want to get an answer before they move on to the next phase. So we're seeing everyone go slower. I would say, as an investor, on the flip side of that equation, we're looking at banks who have closed doors. So now we have to understand, like, well, how did these lenders close doors? What's going on with them? Can I vet these individuals? Are they the right partners? Are they the right investors for us? And I think it's important for you to have that right lending partner, because you don't want to get in a situation where maybe there's a technicality on your loan, or a document you didn't send in time, or whatever it is, and now they're trying to call your loan due, or you don't know about their financial viability, and they may not be in business, next year, 2025. So I think there's definitely more scrutiny on all sides of the table, because those lenders are certainly taking a look at these deals. They are, being really surgical in their analysis and their determination of whether or not they're going to lend. The terms have shifted. I'm not even talking interest rates. I'm talking, DSCR, which is the debt service coverage ratio minimums, the LTV, or loan to value minimums and maximums that they will allow you to take. They're simply not loaning out as much money. They want you to have more equity in these deals. They want you to have more exposure in these deals. And even still, they may not give you the loan, right? So all of that has changed because everyone's getting a bit more risk averse given the economic climate change. And that's making these deals take a little bit longer to get to the closing table.
I'm glad you mentioned that, where lenders are getting a little bit spooked out. It's like, if there's a technical default on your loan, like, you better know about it, because lenders they're hyper sensitive. And what's it like? So what could be a technical default? Let's say, for instance, you're supposed to keep a minimum in the bank account to cover, I don't know, for rents. Okay, you're supposed to keep so usually lenders want the lender that's making the loan, they want you to keep X amount of money in their account, afloat almost, right? And if you don't, you're in a technical default. They can call the loan, and not that they want to, but they can. And if they get freaked out enough, they will. They'll pull that thing right back, and they'll unload it to someone else. So I think the lender is your friend when times are good, but you better watch it when times go bad, because they're not your friend anymore.
Yeah, and Augustino, I will tell you, man, like, the first time I really learned that or understood it was when COVID happened, and we had a deal. We never took any like PPPs or anything like that. But I had a project that was struggling. So, like, it was a JV deal. So me and my partners were, we were writing checks to keep this thing kind of afloat as we were going through kind of a heavier turn. And we never asked for any forgiveness or anything like that. And I actually had another deal under contract that they were going to fund, and they kept dragging their feet. And it was a regional lender, and they kept dragging their feet, and they kept coming up with, like, not even excuse, but they just kept, dragging this thing out. We're like, guys, we need a response. Like we have to close in X amount of weeks. So we ended up having to switch lenders, and I kind of got the vice president on the phone. I'm like, listen, man, like, we have another deal with you guys. I thought we had a great relationship. We brought this deal to you. You dragged your feet. Like, what's going on? And he was like, yeah, we're really getting cold feet about any deals right now. And he's like, and even the stuff we have loans on, we're really scrutinizing them. And at that moment, I just realized, like, you're not a good partner then, because I would have preferred you to tell me up front, hey, John, we're getting nervous. We like the deal, but it's going to be hard getting it through kind of our committee. you should at least explore a backup plan. Instead, I wasted a month with these guys, almost lost the deal, almost lost our, our EM, our earnest money, because these guys got cold feet and were, they would rather me lose my EM than tell me they didn't want to do the deal. So you really want to understand, like, who are these lenders? How do they operate? What did they do when COVID hit? Because I had to call them back and say, listen, guys, I didn't ask you for anything during COVID. I know all these people, hit you up, pause their mortgage payments and all this stuff. We never did. So, and I was trying to refinance that property. I'm like, I can either refinance it with you or take it somewhere else. But you're gonna have to do something. If you're not gonna, cut me a break, then I won't value this relationship, because you're showing me you don't value the relationship, and I'll go to whatever lender gives us the best terms. So, I think you really need to have conversations with your lender and understand the climate of their business and how they operate. Because even if you have a good relationship right now, or there's nothing to worry about, in your mind, you don't want to wake up one day and realize that uh, as an organization, their position has changed, and now they're just looking to take back loans wherever they can.
Yeah. You know what? John, that is something huge right there that's worth talking about a little more, because, like, here's the thing. I have a rule. If a lender does that to me, it's only happened to me twice, actually.
Yeah.
Well, actually more than twice, unfortunately, actually, now I think about it. Where the lender, we have a deal, we sent money, we ordered third parties, all of a sudden they disappear. Same thing happened, right? I will never do business with that lender ever again, ever. And they'll call me down the road, some other representative, and I'll tell them what happened, and I just tell them I'm not doing business with your bank anymore. Done. Because if they did it once, they'll probably do it again, right? Or and the same thing might happen. I'd rather not do that, But I think that in times like this, especially in times like this, communicating with the lender one-on-one all the time, keeping them extremely close with what's going on in your deals, is a way of building that goodwill. So you kind of get a feel for where they're at and what's going on at the bank, because right now the lender's got the money and they're scared to death. They are scared to death right now, because if 2008 wasn't a good time for banks, it was a very bad time. So they're scared. It's funny. There's one lender here in town. They were super aggressive when it came to development. Now it's like, they're not even making loans, period. They're not doing any loans at all. And that's where we're at. But the only reason why I know that is because I stay in constant communication. I call my lenders at least once a week just to say, hey, how's it going? You want to grab lunch? On me. I'll take you out to lunch. It's always good to do that. Keep in touch with them, because if you do need them, they'll at least talk to you. If there's some other circumstance, like you need some sort of forgiveness. I'm not saying that you do, and I'm not saying I would, but you want to make sure they have an option just in case, right?
Yeah, I think that's a brilliant point. You want to stay in communication with them, even if it's bad, even if you're like, I don't know how I'm gonna make the payments, right? Talk to them. And at a minimum, they can help you brainstorm or work through what your options are. What you don't want to do is wait until you can't make a payment and cross your finger and wait on that phone call or wait for that letter to come through in the mail, right? So, like, talk to them and let them know, hey, can we do this? Can I adjust that? What can I do? What are your options here? Have those conversations with people. And I think, too often people aren't proactive when they need to be, especially in the face of bad news, right? And I think that's the time where you want to be more proactive as an operator. If you've got deals that aren't working as well, talk to your lenders, talk to your investors. You need to let them know, hey, here's a situation. Here's what we're doing. Maybe someone has an idea you haven't thought of that can salvage the deal, or at a minimum, at least they know that you care enough. You're being transparent. You're sharing things with them, and you're getting in front of it, and you're recognizing what your options are. And you're trying to make the best of maybe a situation that isn't ideal. So I think that communication is absolutely key, especially with your lender. And the other thing too is, like, your lender is your biggest investor, right? Typically they're investing 50 to 70 or more percent of the deal. So they brought a lot of that cash and equity to the table. You certainly want to make sure you talk to them and you're informing them of what's going on and, how the business plan is progressing, and make sure that they're aware of what they should expect moving forward.
Yep. Hey, listen, you know what? You might want to forget about the payment, but the bank won't. You're going to get a phone call. You will get a letter. I guarantee it. They're not going to, hey, wait a second. What is Joe up to today? I better reach out to him and find out where my mortgage payment is. They won't forget you. They love you.
Yeah, we don't get treated like renters, right? Like it's not like I'm a squat here for the next year until you change the laws to kick me out. It's like, no, we'll just take that from you.
Back. That's it.
Yeah,
But I think
yeah.
something you said earlier, though, I think that it's worth reiterating here is like, aside from all the tough stuff when it comes to putting deals together, I think another big part of it is where the equity comes from. And I think part of it is, if I recall, you really take the time to understand what the investor is looking for. So not just what the bank is looking for in a deal, right? Also what an investor is looking for, right? So how do you really assess, or how has it changed anyway, the investor's goals given where we are today versus where things have been, say, 24 months ago?
I think generally speaking, many of the investors that I'm speaking with are just a little more nervous about kind of the current state. They're looking at more capital preservation and, not really looking at, big returns on projects, but mostly looking at just getting through the next cycle, right? Where do I park my money for the next year, 2, 3 years? I want to find quality deals that I can invest in, but also recognizing that, I mean, unfortunately for us, it's that the value proposition for some of these real estate projects just isn't as sexy as it was 2 years ago. Particularly if you can go into a savings account and get a 4 or 5% return in a savings account, they may say, "Hey, well, why would I invest in, a real estate project and do that?" And there are reasons, and I think there are certainly people who absolutely should still be investing, particularly if you're looking at the long term. Particularly if you can take advantage of any of the tax benefits that come with investing in real estate. And that's something that, is evergreen. So if you can invest in deals, take advantage of the tax benefits, and has it as a part of your overall investing and financial plan, that's still a smart and wise thing to do. If you're only looking to earn a cash on cash return, then yes, there are other options that may be more attractive. But with inflation, I think that's the thing that people have to keep in mind too, is that even earning that, 4 or 5% return sitting in a bank account, I mean, that's barely beating inflation. You still need to invest in income producing assets that appreciate over time. That is still the best way to create wealth in this country that I know of, because the income producing is key, because that's going to allow you to get a little bit of something out of the gate and while you hold it. And something that appreciates is important because you want it to be worth more in the future than it is today. Having something that produces income but doesn't appreciate is only one half of that equation, and having something that appreciates but doesn't produce any income is only half of that equation as well. So putting those two together is still a very powerful tool for investing. And I think most investors still understand that, but they are a little nervous. So you may need to talk to them a little bit about their long-term plans and not necessarily their 2024 and 2025 plans, but hey, where do you plan on being 5 years from now, 10 years from now? Why are you looking to invest? And those things tend to not change as much. So if you can root them into the bigger picture, then most investors recognize that there's still value in playing the long game.
Yeah. I think another big part of it is keeping it realistic as well. I mean, I'm sure you see them on Facebook. These guys are talking about 12% cash on cash return and 25% IRR, and I'm like looking at this like, somebody needs to update their numbers, because there's no way you're going to do that on a C-class asset in Toledo. Like, it's just not going to happen. Sorry, it just doesn't, So I think part of it too is also keeping things real with investors, because that's going to scare investors away too. If something looks way too unrealistic, especially given the cost of capital today, I don't understand how someone could even say those types of things. You've seen those ads, right? I mean,
Oh, I see. Yeah, and it's you know it's tough because and I'm writing an article which will be out probably by the time this drops, but um, I think it's really difficult for people to, especially for investors who are interested in investing in real estate, but don't have all the education and knowledge to decipher, what's real, what's quality, what has been through stringent analysis, where have risks been mitigated. It's a little tougher for them to kind of, navigate that landscape. Um, because maybe they don't know the right questions to ask to evaluate those kind of offers. I think you and I can maybe look at that and recognize something's off right away. And then sometimes it's too late. Well, tell me why. I don't like to be the pessimist. So for me, it's like, okay, you can deliver a 25% IRR and 12% cash on cash. Or what are you doing that the rest of the market isn't able to do? And if there's a phenomenal answer there, they're vertically integrated, whatever it is, okay, maybe I could at least buy into the theory. I mean, we'll still want to see the production, but maybe on paper, I can at least understand the logic. I think where I get more concerned is there isn't anything that they can point to. They just found a deal on LoopNet, and these are the numbers they got from the broker. And I'm like, oh, Lord, that's where I get a little more concerned, right? Is where there really isn't that industry experience or industry knowledge to be able to evaluate these opportunities, but then also be conservative, because if you can deliver a 12 and 25% return, that's amazing. But you should also have the awareness to recognize that returns like that they just feel unrealistic. So for you to say it, implies that you're trying to, and I don't want to say mislead people, but it feels like you're overselling. If you find a deal and you feel like those are the numbers, my suggestion to you is be more conservative then on either your cap rate or your expense ratio or something else, and get those numbers down. And then if you hit it, great for you. Kudos. You can pat yourself on the back and you're the big time winner. But to go out there and share numbers like that, again, unless you have your own construction company and you're completely vertically integrated and you're going to, take your portion on the back end after there's got to be something in there that would make me feel like, okay, well, maybe they can do that. And most people don't. They don't have that.
Right. No, 100%. Man, I can say we could talk shop all day long, but we got to wrap it up, man. So tell me, someone listening right now, what sort of bulletproof advice would you offer them in terms of getting into real estate today? Having a blast? Listen, if real estate's your thing, don't miss out. I have plenty of free resources on the bulletproofcashflow.com website, as well as masterminds you can take part in to help elevate your game. Go ahead and check it out.
So I think the biggest thing for you is to understand your risk tolerance. And if you are someone who is risk averse, then you need to play the long game. I sitting on the sidelines is not my answer. So let me start with that. If you are more risk averse, then play the long game. Look for projects that have a longer horizon where you're not trying to time the market and you're not as concerned with, where things are 24 months from now or 36 months from now. Find properties and projects that have a longer outlook. If you are more risk averse, meaning that you have a longer time horizon, or hey, you want to optimize your returns, then you're fine finding those projects that are more development type deals, or deals that have kind of that bigger upside potential. But just make sure you understand your own investing risk tolerance as you're selecting projects, and recognize too, if it doesn't work, that doesn't mean real estate doesn't work, or it doesn't mean you made a mistake or the strategy sucked. That just means it didn't work. Take a step back, figure out what part of it was a little bit off. Maybe you didn't vet the partner or the operator the right way. Maybe it was the market. Maybe it was the timing of the deal. But make those adjustments, because we know real estate is still the number one wealth generator for most Americans in this country. Stock market's great, but you don't have any control over what happens in the stock market, and you don't get any of the tax perks that come with it. So we know real estate investing is a tried and true proven technique. Figure out how to invest in real estate for you. And it could be different. Some people like development, some people like single family, some people like multifamilies. So figure out what you like and then invest accordingly.
Yeah, love it. All right, guys, if you want to reach out to John, you can reach him via his website at casmoncapital.com. Listen, guys, real estate takes patience and perspective. Even though there's market uncertainty and it's persisting even today, the strong fundamentals will remain for those with a long-term view. So partner up with experienced investors like John, learn from setbacks that maybe he's had or other guys like me have had, and stay focused on the core principles that make a deal worthwhile. And of course, always surround yourself with positive influencers and positive people that share your values. That'll help you stay the course and get those returns that you're looking for. Okay, guys, thanks so much for tuning in. I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.